What if the safest, most reliable asset in the world, the foundation of American wealth, the thing your parents told you to save for, the thing every financial plan assumes you'll eventually own, is quietly slipping out of reach, not because you're bad with money, not because you didn't work hard enough, but because a system you never voted on is making it more expensive every single month. Right now, the average 30-year fixed mortgage sits at 6.49%. The median American home costs $429,000, and a monthly payment on that home with a 20% down payment is over $2,100 every month. That's $25,000 a year, just in mortgage payments, before property tax, insurance, or repairs. And here's the part nobody's telling you. This isn't going back to 3% anytime soon. Stay with me, because by the end of this video, you'll understand exactly why this happened, what keeps rates stubbornly high, and most importantly, what you can actually do about it. Let's start with what this actually feels like. In 2021, you could get a 30-year mortgage at 2.65%. That was the all-time low. On a $400,000 home with 20% down, your monthly payment was roughly $1,290. Today, that same loan at 6.49%, $2,023 a month. That's $733 more every single month. That's $8,800 a year in extra interest gone. And it's not just the rate. Home prices haven't fallen to compensate. The median existing home price in May 2026 was an all-time record high for that month. $429,300, up from where it was just a year ago. So you're paying more for the house and more to borrow the money to buy it. No wonder 62% of would-be home buyers in a recent survey said they're still waiting for rates to drop. Here's the cruel twist. They waited in 2025 too, and rates didn't fall. A whole generation has been sitting on the sidelines, watching prices not go down, watching rates not go down, watching their window get smaller. And it's not just millennials. The Harvard Joint Center for Housing Studies just reported that home ownership costs have risen so dramatically that a household would need an income of over $120,000 just to afford payments on the median-priced home. In 2020, that number was $66,000. That's not a rate problem. That's a structural squeeze. To understand why your mortgage rate is 6.49%, you have to understand one thing. Mortgage rates don't follow the Fed, they follow the bond market. This is the part that confuses most people, and most financial media gets it wrong. When the Federal Reserve raises its benchmark rate, people assume mortgage rates go up automatically. When the Fed cuts, people expect mortgages to fall. But watch what actually happened. The Fed cut rates 3 times in late 2024. And mortgage rates went up. Why? Because 30-year mortgages are priced off the 10-year US Treasury yield, not the Fed funds rate. And the 10-year Treasury is set by bond markets, which are set by one thing: inflation expectations. Here's the chain. Inflation rises, leads to bond investors demand higher yields to protect their returns, leads to the 10-year Treasury yield, climbs, leads to mortgage rates follow, leads to your monthly payment goes up. Now add the Iran conflict. Oil prices spiked. Supply chains tightened again. The PCE inflation index, the Fed's preferred measure, came in at 4.1% in May 2026. That's the highest level in 3 years. The Fed's target is 2%. We are nowhere near 2%, which means the Fed isn't cutting aggressively, which means the 10-year stays elevated, which means mortgage rates stay in the 6s. And there's another piece of this that almost nobody talks about: the spread. Normally, a 30-year mortgage rate runs about 1.5 to 2 percentage points above the 10-year Treasury. Right now, that spread is wider than usual, closer to 2.5 points. Why? Because mortgage-backed securities have become riskier in a volatile rate environment. Banks want a bigger cushion, so even when Treasury yields edge down slightly, your mortgage rate barely budges. Here's the honest forecast. Wells Fargo projects 30-year rates to average around 6.2% through the rest of 2026. Most analysts see the low to mid 6% range holding as long as inflation stays elevated. The CBO projects the 10-year Treasury yield at 4.1% by end of 2026. which puts mortgage rates somewhere in the 6 to 6.5% range. There is no imminent rescue coming from the Fed. But rates being high is only half the problem. The other half is why inventory is still so thin. It's called the lock-in effect, and it's quietly freezing the entire housing market. Here's how it works. Roughly 60% of existing homeowners have a mortgage rate below 4%. Many locked in at 2.5, 3.5% during the pandemic. To sell their home and buy another, they'd have to give up that rate and take on a new loan at 6.5%. The math just doesn't work. So they stay, they don't sell. And because they don't sell, inventory stays low. And when supply is low and demand is still there, prices don't fall. The market isn't broken by accident. It's frozen by design. Frozen by the gap between where rates were and where they are now. Some of these homeowners are becoming what analysts call accidental landlords, renting out homes they'd rather sell just to avoid giving up their rate. The result, home prices are up 54% since 2020. The price-to-income ratio nationally now sits at 5.8 times median income. In 1985, that ratio was 3.5. In high-cost metros, it's hitting 7 times, even 10 times. 65% of US households cannot afford the median-priced new home. In 39 states, that number is even higher. This is not a fringe affordability problem anymore. This is the mainstream American experience. Alright, so where does that leave you? I'm not going to tell you to just wait for rates to drop. That's not a plan. That's hope dressed up as advice. Here's a real framework, depending on where you are right now. If you're currently renting and want to buy, first run the real math. Not the emotional math, the actual numbers. The rule of thumb is your total housing payment shouldn't exceed 28% of your gross monthly income. At 6.49%, that means you need a household income of roughly $100,000 plus to comfortably afford the median US home at $429,000. Be honest with yourself about whether you're there yet. Second, consider smaller markets. The national average masks enormous variation. While coastal metros have price-to-income ratios of 7 times to 10 times, Midwestern and southern cities are still under 3 times. Your dollar goes 3 times further in Columbus, Ohio than in Los Angeles. Remote work makes this a real option for more people than ever. Third, talk to a lender about mortgage points. In a higher rate environment, buying down your rate by paying points upfront can make sense if you plan to stay in the home 7+ years. Run the break-even math. If you already own a home and are locked in at a low rate, you are sitting in a privileged position right now. Don't disrupt it unnecessarily. If you need to upgrade space, consider renovating before you relocate. HELOCs, home equity lines of credit, are one option to access equity without giving up your mortgage rate. Just understand the math. HELOC rates are variable and currently elevated. If life circumstances require you to move, don't wait for 3% again. It may not come in your planning horizon. Instead, focus on negotiating seller concessions. Many sellers in soft markets will now pay points to buy your rate down, effectively subsidizing your mortgage cost. If you're still years away from buying, this is actually a strategic window, not a crisis. Build your credit score aggressively. The difference between a 680 and a 760 credit score at current rates can be 0.5 to 0.75% on your mortgage, which translates to tens of thousands of dollars over 30 years. Save your down payment specifically into a high-yield savings account. You can currently get 4.5 to 5% in HYSA products while you wait. Your down payment is earning while you build it. And most importantly, stay educated. The people who buy smartly in this environment won't be the ones who waited for rates to be perfect. They'll be the ones who understood the market, chose their timing deliberately, and negotiated hard. Here's the honest truth. The era of cheap money is over. The 3% mortgage wasn't normal. It was an emergency policy measure, a sugar rush the economy needed during a pandemic. We are paying the interest on that decision now in multiple ways. But that doesn't mean home ownership is dead. It means the calculus has changed. Location matters more. Timing matters more. Credit and income matter more. And financial literacy, knowing how rates work, why they move, What you can actually control matters more than it ever has. The American dream is not getting cheaper anytime soon, but it is still achievable if you stop waiting for the market to save you and start building a strategy that works in the market you actually have. If you found this useful, there's more where this came from. We cover the macro moves that hit your wallet every week, right here on Dollar and Demand. Hit subscribe. See you next week.